I was recently talking to a real estate investor who also works a full-time job, and he was interested in doing the active, exciting type of real estate investing, like buying low-priced fixer-upper rentals or buying short-term rentals with a lot of cash flow. And he had a good reason. He wanted to reach his goals, like achieving financial freedom faster, like in 7 or 10 years. But I suggested a different path for him, buying boring rentals, which means owning pretty properties in nice neighborhoods with just okay rent-to-price ratios, and also putting very large down payments, sometimes 40% down, in order to make a positive cash flow. Long story short, this investor wasn't that excited about my suggestion. Maybe you aren't either, but you should be. Because for many of you, especially if you're working a full-time job and you have good savings, this could be the best strategy to help you achieve your goals. And in the rest of this episode, I have a conversation with expert real estate strategist Erion so that we can explain this boring rental strategy and how it can make you rich. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson, and this is a show to help you get out of the financial grind so you can spend your time doing more of what matters. Now let's get to my interview with Erion. Is there anything that comes to mind first for you that we could talk about these boring rental strategies and whether you could actually get rich with them as well?
No, yeah, that's a great question because I get a lot of the same questions from investors. They're looking for excitement and things like that. But I want to sort of start where this idea of the 40% or 30% down came from. And it basically originated from the fact that interest rates increased. Right? Like nobody was talking about, oh, these things are boring when interest rates were 3 and 4%. Like everybody was perfectly happy, right, to make those investments then. But now that interest rates have increased, what that has caused is that people now are having to put more money down just to kind of rebalance and find a new equilibrium on the property. Here's my question. If interest rates went up, right, and now your boring strategy is not attractive to you anymore, what about interest rates going up benefited these other strategies that we are talking about? So if we're talking about the burst strategy, that's not immune to interest rates going up, because when you go to, you buy, you renovate, you rent, when you go to the refinance step, because the interest rate is now higher, now you're going to have to pull a smaller amount out to kind of make sure that you don't leave the property in a negative position. So how is that any different from putting more money down when you purchase it? It's the same effect. On the other side, if you're doing like a short-term rental or Airbnb or something like that, I can't think of any benefits that asset class has from interest rates being higher. But I did hear a story the other day about how in one of the hottest Airbnb markets in the country, which is Maui, they are now changing the law where they're going to phase out all Airbnbs so that they can create more housing supply for residents. So where does that leave the people that are looking for that excitement if now your projections where you were going to get $300 a night, $400 a night now are outlawed? So that idea of losing control, to me, it's less attractive than the boring strategy of putting 40% down or 30% down.
What I want to talk to you about, Erion, is I want to unpack this, just the basics of real estate, really real estate investing 101. You've mentioned the financing. Like the financing is always like a key component. And so the financing has changed. Interest rates have changed. How we make a positive cash flow or even a break-even cash flow has changed some. We all know that. That's the thing that's changed a lot. What I think people are kind of missing, though, is this boring real estate strategy that we're talking about, where you buy a property, you just sit on it. You're not doing a lot of fix up to it. You're buying it in a better location. Let's talk about the asset itself, because there's the financing and there's the asset. Is it worth putting a big 40% down payment? I think that's the pushback I'm getting. It's like, why would I put all that money down? And I could just go invest in the stock market. I could do something else. Like, let's talk about the merits of actually buying a piece of real estate in a well-located region where there's good demographics, because I want to qualify what we mean by the boring strategy. This isn't just buying any piece of real estate. This is being very careful about buying the right location, the right neighborhood, even the right property, so there's low maintenance. Can you unpack the benefits of that strategy and how this could actually help somebody get to where they're trying to go?
Well, let's look at an analogy that can, I think, explain this a little bit better. So let's say that you own a business, and this is a sound business. It's a profitable business. You sell products that have good margins. You operate it well. And then this business needs financing. Well, if the financing terms are not favorable, you don't say, well, I'm just going to get out of this business and I'm going to go and do another business. It's like the financing part of it, sort of the perversion of the idea is that in real estate, it's almost like backwards. If you have a business and you need financing, the financing is a tool for the business. So basically, it's a tool that the business uses to bring capital in so that they could invest in marketing or equipment or what have you. And always the financing is tailored to fit the business needs, as well as the business's resources, like how much the business can afford to pay monthly and so on. But in real estate, it's almost backwards. It's like, well, no, this is the financing that I want. So now I'm going to go and find properties that work with this type of which doesn't make any sense at all. So the thing to understand is that financing is temporary and the asset is permanent. There's an interesting statistic that the average investment property loan in the US is outstanding somewhere a little over 4 years, because people either refinance or sell it or pay it off. So why would you make long-term decisions, asset decisions, based on something that you are likely to keep 3, 4, 5 years? That doesn't make sense from a long-term investor perspective. But also, the biggest thing that people miss is that it's what I like to call the 80-20 rule of real estate investing. And that is that 80% of profits on any successful deal that an investor makes come from capital appreciation, and 20% of profits come from cash flow. Now, there are deals that obviously will vary, but we're talking in general, as a rule of thumb, if you unpack any deal, and I'm not talking about short-term deals where you bought it and you got out in a year or year and a half, but let's say if you hold the property for a minimum of 5, 6 years and you buy it, it cash flows over time, and then you sell it, 80% of those profits are going to come from capital appreciation. And most of that capital appreciation comes from the leverage factor, your ability to go and borrow and basically control 100% of an asset with only a portion of the capital coming from you. Now, obviously, the smaller the portion that you put down, the higher that leverage factor is. But going back to the business example, if the business can't afford to service that debt at 25% down or at 20% down, then the business is going to basically borrow less, right? So we are making the same suggestion here. It's like, yes, your leverage factor is going to go down, but it's still, if you're putting 40% down, you are still multiplying any future growth by 2.5 times. So, sure, it would be better if it was 4 times, right? If you put 25% down, but that is you basically adapting this financing to the current market conditions.
I love the idea that the financing is temporary, the housing, the property is permanent. And I want to give just kind of double click on what you just said, is that the fundamental drivers of your profits, you said the source of your profits. It's really important when you analyze a deal to understand where they're coming from, particularly in the more quality asset classes, quality houses, quality duplexes, 80% from capital appreciation, 20% from cash flow. And that capital appreciation, just to give a concrete example, if you had a $400,000 property that you put 40% down on, so you got $160,000 down, it's a big down payment. Who knows what they're going to appreciate at? But if that property went up by 5% for the next 10 years, then you're going to actually 2 or 2.5 times that appreciation because you have leverage. Even if you put 50% down, you would double the effect on your return for whatever that appreciation is. So if you have 5% appreciation, the return on your investment could be 10%, could be double that, even with a big down payment. And then you have a little bit of principal pay down, you have some other things. So I think that's a concrete example. I don't know if you want to add to that, but if that's your strategy later on, that's still there. That appreciation is still there.
Right. It's a little bit higher than that because your 5% appreciation that the market's giving you, that compounds over time. So if you got 5% over 10 years, that's not 50%. That's more closer to 65, 70%, right? So that 70% gets then multiplied by 2.5 times, which is the leverage factor. That is what makes real estate such a special asset class, is that other asset classes have this, like stock markets have, where you invest on margin. But that is a strategy that if you apply it, it can ruin you because you could lose a lot more than your capital investment. Whether real estate allows you sort of the same leverage factor, but without any of the risk that margin investing has.
Yeah, you get a 30-year mortgage. Only good things are going to happen, even with an 8% mortgage. As long as you can afford to hold it today and you have some good reserves today, I always tell people right now, all right, let's talk about a couple potential scenarios. Scenario number one, let's say inflation continues in the current pace and the Federal Reserve is worried about inflation. What if interest rates go up? It's possible. It's gone up in the past. You'd be happy to have an 8% fixed interest rate mortgage when interest rates on the market are 10%. That'd be a good scenario because more than likely your rents and your price in that scenario have gone up. And so you've benefited from appreciation and you have fixed leverage. And then the other scenario, which you talked about, financing is temporary. Let's say inflation does kind of come down and we're not quite as hot in the asset market in terms of appreciation. But at that point, maybe interest rates come down and at 6%, you can refinance and now have more cash flow. Or maybe you can pull out a little bit of that down payment you made if you want to. So those are two potential scenarios, and your financing is temporary. The asset's permanent. That's the key thing I want people to remember that you said.
Right. So you were basically talking about earlier, like figuring out where the issues are with your property. So one lens that I like to use with this is what I like to call above the line, below the line issues. And what I'm talking about here is the line is your net operating income, which is the income that the property makes if you had no debt, like if you bought it for all cash. So when I talk about above the line issues, above the lines, you have rent, vacancy, operating expenses. Below the line, you have debt and like large capital expenditures. If you have above the line issues, what that means is either your rent's going down because rents are decreasing, or because vacancy is increasing, or operating expenses are going up. So property taxes going up, insurance going up, maybe homeowner association dues going up, things like that. If you have above the line issues, those reflect more the asset quality. If you're in an area where rents are declining, that should give you at least pause to analyze, not to necessarily exit, but you have to think like, hey, why are rents declining in this area? Is it like, for example, Austin right now, there's a slight decline in rents. Is that because the market has fundamentally changed, or was it that they went too high to begin with and now they're sort of coming back down to a more reasonable level? And if you have areas like property taxes or insurance where things start to get out of control, you start to see like, hey, is this sustainable? Because all these things affect the asset itself, like how the asset performs independent of the financing. When you have below the line issues, those are things that we're dealing with now where, interest rates go up, or maybe Fannie Mae changes the guidelines like they did 20 years ago, where before you used to be able to buy with 10% down and now you went to 20% down, things of that nature. So that's the part to understand, that if you have above the line problems, then you should question your asset and you should question whether you should own that asset anymore or move to an asset that doesn't have those problems. If you have below the line issues, you restructure, because financing is not mandatory, right? Is required for a lot of people, but it's not mandatory in the sense that it is completely possible for you to buy property with no financing.
If the asset is good enough, if you have a good enough net operating income, if the rents are going up enough, you could find, theoretically, even if you didn't have any cash yourself, I've done this many times, you go find a partner who puts up $300,000 in cash, and you basically have a free and clear investment, and the two of you figure out a way to split it. Maybe you pay them, the first 5% that the property brings in, and then you split everything above it. There's a ton of ways to structure it, but I think that's the paradigm here, is that the person who says, I need to do all these active investments, I need to do these other things, because they're doing what you're talking about. They're starting with the financing and saying, I want to put 20% down. I want to have a certain amount of cash flow. Therefore, these boring properties aren't working anymore for that particular way I do real estate. Therefore, I want to chase properties down the price range. I want to chase short-term rentals. I want to chase these other things. And they're not ignoring this really important paradigm, which Warren Buffett would say is the same thing in the investment world of stocks. He would say, you look at the business fundamentals first. And that's what we're saying. We're saying, start with quality properties, start with good demographics, start with low maintenance, start with a good net operating income, run the numbers as if you didn't have any financing, and then you go below the line. I love your accounting reference. The bookkeeping nerd in me is like appreciating those little lines in the conversation there.
Right.
Then you start figuring out, like, there's a puzzle piece of the financing, which is, okay, given this asset that I like, that has a certain return, how can I put the puzzle together to make the financing work? It's this opposite. We're not starting with the financing. We're going to the asset first.
Correct. And another, I think, interesting way to look at this is that for me is like, I want to compare strategies under the same bucket, right? So if we're talking about passive investing, and by passive, we don't mean you don't have to do anything. We just mean you're not actively involved in a business plan. You sort of acquire the asset and operate it over time. Then I want to compare within that passive model. I want to compare all the alternatives that are available there. If we're talking about an active strategy, right? So if we're talking about, let's say, operating an Airbnb, to me, that's almost not in the same category as real estate investing. We're getting into the active business category. And if we're talking about active business, then you have to compare that business model, the Airbnb business model, with you starting a business. Like if you're going to go active, then go fully active. There are much better business models that have higher margins than investing in real estate in an active way, right? So to me, it's like those aren't in the same, like you are really shifting the entire system here. Like if you're talking about passive, if we're talking, that's what we mean by boring. Passive investments should be boring. It should be sort of repetitive.
And if you want to do Airbnb, which I like the model of Airbnb, I think it would be even better to split that investment into two analyses. Number one, I'm going to analyze it as the boring investor who bought this property just to hold long run. And then number two, on top of that, I'm going to put a business called Airbnb, which is essentially a hospitality business. And then you can judge each of those on their own merit. It's almost like, could I buy this boring investment that's going to have an Airbnb on top of it and master lease it or lease it to the Airbnb person who happens to be me as well? Could I lease it to them and then they could still make a profit and I could still make a reasonable profit? And if that's the case, then great. But if it only works because you do Airbnb, that's when you get the problems and the concerns, because you now own a piece of real estate with a business that you're confounding your analysis a little bit. You're mixing the two.
Yeah, exactly.
One other thing that we haven't mentioned yet, and so the person I think I'm mainly talking to in this conversation is this passive investor, who makes good income. They make a lot of money at their job. They have very little time on the side. Maybe they have like less than 5 hours per week. They have pretty good saving habits. So this is a particular person, like the person who has a ton of time and not much money. You need to go do some active businesses, like no doubt about it. But this person we're talking to, Erion, I think we also need to talk about the time investment. You mentioned it a little bit, but should a person who has less than 5 hours per week with a big down payment, with a good income, be getting into active businesses, or should they be doing more passive investments? So maybe you could talk about that a little bit, just that person themselves and the way they should be thinking about how they approach real estate.
The time constraint just will not allow them to do an active business properly, right? Active businesses, you own your own business, and I do as well. The one thing that you don't get with an active business is a 4-hour work week, right? Like that does not exist, right?
Doesn't happen.
So
nope.
If you have the available time, starting a business is one of the best things that you can do for your career, for your financial future. But if you don't have that time, starting an active business is a recipe for disaster. I would also break down, it's like, hey, if you're at your job and you're earning $200,000 a year, $300,000 a year to be able to have the capital that you've been able to save, I mean, what is that per hour, right? So you have to figure out, okay, are you doing the same value activities in real estate? Like, is real estate, the active investment in real estate, paying you the same as what you're currently earning, for a company? So it does not make any sense to go and do an active real estate investment when you don't have the time. And even if you had the time, when the payoff is not what you're currently earning, you're better off getting a side job or becoming a consultant or what have you. So it does not make any sense for a person who does not have the time to do a fully active business to invest in more active forms of real estate investing.
Yeah, in the end, the goal here is to have financial freedom. And financial freedom in the end doesn't really care how you got your income, whether you're an active investor in the beginning, whether you're a nurse who just like concentrated on being a nurse and made good money and saved their money. They both can end up at the same spot. The question is really what we're trying to say here is you got to be aware of what your strengths are, where your best ability to earn income is. And for many people, it's just like double down on the job, like just make more money. That's your engine. Like that is your number one way for you to build wealth. Real estate is just the place where you're putting that. It's just a vehicle where you're putting that money. Your ability to save up 50, 100, 150,000 bucks, that is the thing. And your ability to get a loan, use your credit, like that's your competitive advantage. So just like own it, like live with it. This is just the season of your life. You can still be an active investor. 5 or 10 years from now, you just have this itch to be an entrepreneur. You got your whole life in front of you, but being an investor first while you make good income at this job is a perfectly legitimate model. Might be one of the best models. I often think about it. I was an entrepreneur my whole life, but man, I had a lot of roller coasters, and I have some friends who are doctors who made $500,000 a year and just set money aside, and they had a much smoother path to get to financial freedom than I did as an entrepreneur. I wouldn't trade it for anything, but it's okay if that's your route.
Yeah, and especially if you sort of project it out over a longer time frame, like a 10-year time frame, the person who does boring passive investments 4 or 5 times during that decade is going to do on average better than the person who's sort of side hustling an active investment on their spare time, just because the return on that time is not that high.
All right. So we've tried to convince everybody the boring investments are a way to get rich. You can still get that, and you can actually still do it in a very reasonable period of time. I know the clients you work with, Erion, and the people I work with as students, a 7 to 10 year plan is a very normal, reasonable time frame. So I think that's pretty optimistic. I'm excited about that. No matter boring or not, what an amazing strategy that you can invest big down payments, quality properties, and maybe 10 years from now, be able to have some optionality to do something different with your life. That's pretty amazing.
Well, and the beauty of the financing is temporary idea is that is also temporary on the positive, right? So that means if rates drop later on, or if rents increase over time, then you have optionality to go and pull some of that capital back out or borrow more money at lower interest rates if the property can sustain it, and then allow you to do more active investing down the road. But the only way that becomes an option for you is if you do the boring thing now and own the asset by that time.
Erion, it's always a pleasure talking with you. It's fun to have these conversations. I want to let you tell everybody where they can hang out with you, because they should connect with you, whether they want to work with you as an agent or with your property management business, or just follow you online. So let people know where they can connect with you.
I always love being here. They can connect with me on my website, signaturehouston.com, on Twitter at Invest Architect, or on LinkedIn.
I will have links to all of that in the show notes and the podcast and YouTube description. Erion, see you soon. Look forward to talking to you again.
Thank you.
So I hope this episode has convinced some of you to pursue the boring buy and hold rental strategy. But something we didn't cover in this video is actually running the numbers on real life case studies or examples so you can see how this actually works. So in my next video, a solo episode with me, I pull out my whiteboard and show you how to actually run the numbers and do deals just like this, even with interest rates that are 8%. If you're watching on YouTube, you can click on the thumbnail above me here, or you can click on the link in the podcast or the YouTube description below. See you in the next video.